Again, everyone. So today also we got Ritesh Jain, sir, founder at Pinetree and NRIZen. He's a macro trend watcher and strategic advisor. Has been, closely monitoring the macro trends happening globally, and we will try to ask certain questions around that. And I hope all the questions will help you form some opinion what's happening globally. And again, that is a starting point for everyone. So, sir, all the things happening. What's your reading on the Fed Chair Powell's recent commentary and how you should be taking those outcomes of the speech, basically?
So we have to look at it in a very different way that US is in a debt trap and they are trying everything to get out of that debt trap. In to get out of the debt trap, they need a coordination between Treasury and Federal Reserve. Now, I'm pretty sure anybody listening to US Treasury Secretary can feel that they want to inflate away the debt and reduce the interest rates. But reduction of interest rates is not in the hand of US Treasury Secretary. It is in the hand of US Fed. But in this brave new world, Treasury and Fed needs to be merged. If US wants to regain the stature of, that premier country back, which can only be done by inflating away the debt, which is like targeting nominal GDP. And for that, you required lower interest rate. And yesterday, we got the first indication from the Fed chair, who till now was very stubbornly was talking about that I am different. I will go only by my mandate. Yesterday, two things happened. One, he acknowledged that labor market is weakening. But it is only 1 month data. Then how can you say that labor market is weakening? But he still said labor market is weakening. Secondly, he said that the tariff impact, yes, it will be inflationary, but we do not think that it will be having a multiplier impact. So we are willing to overlook that one-time impact of tariff. It effectively means that he is abandoning his goal of inflation targeting along with higher employment. They will only look at employment. They will not look at inflation unless and otherwise it goes out of whack. But for the next 2-3 months, if oil remains here and they are able to overlook one-time impact of, that tariff, they will be cutting the rates in September. So going into this yesterday, market expectation of September rate cut had come down, but now we have almost 100% expectation of a rate cut in September. We could have one more rate cut after that thing. So what you are finding now, effectively what I think is Fed has understood, or it is ready to support the US government in its quest for nominal GDP targeting, and outcome is reducing debt to GDP. So but historically since 1990, if the core inflation has risen by more than 3%, which is possible in the August data, they have cut the rates only once. So this will be the second time in the history when the core inflation is close to 3%. They will be cutting the rates, and that's what they have told us yesterday.
Perfect. And sir, what's your view on the transition? So basically, we used to hear "don't fight the Fed," but nowadays it's
Hmm.
like "don't fight the fiscal" or "don't fight Trump." So
Yes.
what's your reading
So
on this
don't,
transition?
correct. So remember, we used to always talk about exactly don't fight the Fed. That was important when interest rates were the determinant of the economic growth. Interest rates were the bigger determinant of economic growth. After COVID, Fiscal policy has taken that role away from monetary policy. So don't fight the fiscal is the real answer. Having said that thing, they cannot continue to spend money unless the interest rates are lowered, simply because for the first time in the history of United States, the interest on national on debt is more than the what they spend on defense. So that roughly means they will be spending more than $1 trillion, let's say, on as interest on their national debt of $37 trillion. Now, if you reduce the rates by 100 or 150 basis points from there, they will have more space to spend that money on other things. So what you are finding in front of you is fiscal policy is running like it is a world war. You have a 7% fiscal deficit even in this kind of market in United States, where the unemployment is low, where the GDP is okay, but it's a nothing stops this train is what Lynn Alden has actually, this is one thing which she's just coined this term. Nothing stops this train. What is this train? This train is fiscal spending. What does this train requires? This train requires lower interest rates. And that is the indication you got it yesterday. So what you are finding now is effectively, for the time being, merging of fiscal and monetary policy.
Perfect. So there are certain question around gold and silver, and some people are also asking about Bitcoin. So the
Hmm.
question basically is like in sync with the Fed commentary, where we see and the forthcoming, anticipated rate cuts. So what would be your view on gold, silver, Bitcoin going forward?
Okay. Gold never cared about interest rates. Actually, if you see it, whether the interest rates are cut or not, it never cared about. There was a chart where if the real interest rate rises in US, gold used to go down. It was a perfect chart which continued till 2022. After 2022, when Russia's foreign exchange reserves were sanctioned and confiscated by Western world, that chart stopped, having the same correlation what it was having earlier. So today, interest rates have no correlation to the gold, because gold you have to consider as a neutral reserve assets today. Once you think that gold is a neutral reserve asset, last 3 months price action for you is very clear. If you think gold would have put gold is a bubble, it would have completely burst. It has happened 3-4 times in the history. What you found was gold had risen dramatically, but had gone sideways. It was basically waiting for some other event for it to break out. I'm firmly of the opinion after Jerome Powell U-turn yesterday, we could easily see between 3,800 to 4,000 on USD gold before the end of the year. And if that is my view, I would extrapolate over here and say that gold miners, silver miners and silver will be having much higher percentage gain as compared to gold for the next few months. Now you are coming for Bitcoin. I don't understand Bitcoin, but I understand what they're trying to do with stablecoin. So if you want, I can explain you what they are trying to do. So if they're trying, so I have built up an understanding of stablecoin. In that stablecoin world, Bitcoin has no role to play. Getting my point? That in a stablecoin, what they're trying to promote, Bitcoin has no role. Bitcoin is nothing then at that point of time. So once you need to start understanding stablecoin and not spend more time on Bitcoin.
Perfect. And Ritesh, US is, following on footsteps of China. Then why is China not investable and US is still investable?
Who said? Shanghai touched 10 years high yesterday. Last 2 years, or KWEB, which is a China tech ETF, has beaten US tech ETF. It's in your mind that it is uninvestable. Price action is completely different. Look at it. 10 years high on Shanghai on Friday closing. When was the last time you saw it? It's just that in your mind, it's a Western world media which you listen to has told you it is uninvestable. But there's a raging bull market in Hong Kong and China stocks at this point of time. And China is also, I had written it in this month's uh, my fact sheet also. China has been one of our holdings for some period of time. So don't read what the Western world tells you. You have to make your own views about it. One more thing. Everybody's overweight on on US. US is only 26% of global GDP, but 65% of global market cap. People are massively underweight on Chinese assets. And in front of you, China markets are actually exploding higher. And
And
think about it. Why were you not investing in China? Has US not done the same thing with China, does it? China has a CCP member on every company's board. Isn't US through Department of Defense buying stakes in the companies? Sometimes even arm twisting them? US is nothing more than China with, it's like China with its capitalist characteristics. Nothing different today. And that is actually, it's not one-off. US is actually going in that direction because it is required for their national security.
perfect. And with China opening up to India, is there something to read? And is it too early to say, being China known for, this?
No? Why are you saying that thing? I had written last year, a year back, Doklam will be in your rear view mirror. In this brave new world, there are no permanent enemies and no permanent friends. Wherever India is a non-aligned country, wherever it can find its benefit, same thing goes for China, same thing goes for Russia, same thing goes for US. They will all like to do it. The thing is, US still continues to act as a bully simply because it's a reserve currency status they have, which is diminishing day by day. I strongly believe what will happen over the next 2-3 years, possibly 5 years, you will no more hear about any more conflicts between India and China. Whatever is, let's say something which is something non-negotiable, it will be pushed into the future. Indian companies are not doing any corporate spending, justifiably so, because corporate India's cash flow, debt levels are one of the lowest in the last 25 years. So they are not doing any capex. Government cannot continue to do capex because that is not government's job. We want foreigners to come in our country, invest in our country, hire our people, sell to our people, and export from India. Japanese are willing to do it, and now Chinese are willing to do it. Chinese earlier were allowed to come into India, and they got into all the services related where you could extract from Indians through fintech platforms and all those things. You would have known about it, which we closed down completely. We are going to allow Chinese, and this is a Niti Aayog document, 26% stake in a lot of sectors where India wants to manufacture. We will allow Chinese to come and invest in India simply because Indian corporates are not investing. So why not have Chinese corporate coming, investing in India, bringing their technology? I hope they are able to hire our own people, hire Indian people, make in India, make for India, and export from India. This is a new world. So you cannot have permanent. You've seen what US has done to India. One person has broken. The relationship has gone back few years. So
So
don't be enemy.
anytime,
Don't just look at the media telling you something about China. US has not done something differently for you, with you.
anytime, see, we are not going to see the relations get better with the US, right?
No. It is all transactional now. In a reserve currency world, where the reserve currency is willing to share its GDP with rest of the world, keep military umbrella, treat everybody like their own kids, that world is over. Today, US says, I consider me as one of your competitor. I'm no more the reserve currency. I don't have that generous heart to share my GDP with all of you or offshore my factories. I want my factories back. US today is acting like a mafia. They say, we want our factories back. We want to produce everything in our country. We don't want any immigration. Never in the history, a reserve currency has behaved like this thing only when it is towards the end of the empire. What I can see today, everybody can see around me, across the boardroom, across countries, where US is just acting as a henchman. Possibly that is right for them because they have too much debt. They will drown under their own debt. Historically, every empire has collapsed simply because they had too much debt and entered into never-ending wars. So consider US as India competitor now, not the reserve currency. And then look at this new world. It will be a transactional relationship with each and everybody, possibly except India and Russia, which is a 50-year-old relationship.
Fair point. So Vishal as a question is asking, will bond market revolt, yields rising significantly in current situation?
They will not allow it. They will simply not allow. So there has been two times where move index, consider move as VIX of equity, move is bond. So we used to always historically look at VIX. Rising VIX means there is a problem, so you sell equities. But now you sell equities not because VIX is rising, because move is rising. Move is the bond index, bond volatility index. The last time bond volatility index touched 140, which is at 80 currently, Liz Truss lost her job overnight. Everybody after that, every government after that understand that thing. I'm firmly of the opinion that 10-year bond in US will not be allowed to rise to 475, 480 levels kind of thing. It will not rise beyond that thing. They will find a way. So let me give you a small example. After what, Jerome Powell has done yesterday, let's say they have gold on their book. They've already released a paper that, every country is taking that, updating the price of gold, what is the current price, and they're taking away their money in treasury. So same way, US has gold, 8,000 tons of gold at $42. If tomorrow worst come to, bond yield starts rising and all those things, US can actually revalue the gold at the current price, take that money from US Fed, because they will have to do it, and then immediately curtail the long-term borrowing. They will only borrow at the short term. And at the short term, what they are doing is, they've just passed a Genius Act. Stable coins. What does that mean? If you are an exporter from India to United States, you export to US, you will not get US dollar. You will get a US stable coin, which will be on the app on your phone. That stable coin will be issued through a US entity to that exporter. That stable coin will not invest in bank, will invest in US Treasury. So they're already taking sure if long-term bond yields rise, they will revalue gold. For short-term bond yields, because simply they have too much debt, they need to borrow money. Stable coins is a way. Cut down the banking system, directly lend it to US Treasury. So forget about in a normal scenario, bond yields rising. Yes, if oil goes to 110, 120 kind of thing or something else, wax out of happens, then I do not know. But in this kind of environment, do not get worried about bond yields rising to, another 40, not rising more than 40 basis points from here. 10-year bond I'm talking about. 30-year bond, Western world will not be able to control.
All right. So Anuj is asking, what's China's incentive? Why will they make in India and export when they can manufacture cheap themselves and with great ease of doing business?
Correct. The same thing is true for Japan also. The problem is demographic decline. They simply do not have demographics to sustain beyond 15, 20 years. Same thing is with Canada also. You might have very bad relationship with Canada, but Canada pension plan still invest in India. All these societies are becoming aged very fast. When you become aged, you need continuity of some asset which can continue to pay out to pay for your retirement. Every country which is looking to invest in India is looking only from one perspective. We are getting 1.4 billion people, possibly the youngest population in the world of that large stature. Okay. So we have to invest in India simply because we have a consumer market. And on top of that thing, we have a market which can produce for us for next few years or next, who knows, next decades, and pay for our retirement, pay for the old age, which will lead us to be asking for more resources than to be giving resources back to the society. That's what everybody's looking for in India, whether it is Japan, whether it is some of the European countries, whether it is China. US does not need that thing with India simply because in Western world, US demographics is the best. The same way outside of Western world, India's demographics is the best. I'm keeping Africa outside. I'm keeping Africa separately.
Okay. Sachin is asking, what do you think about other developed markets like Canada? How would their real estate and equity markets react to this?
Canada's real estate boom is over. Actually, it is boom is over for the next few years. Forget about the real estate boom. Canada's real estate boom was actually a pyramiding scheme. On top of that thing, last 5 years you had immigration. So much immigrants coming, leading to higher rentals. Higher rentals means the people who owns that house became very, very comfortable, confident that prices are rising. So they started buying new houses. I believe the immigration to the entire Western world is over. Even if Canadians don't want, Americans will make sure that immigration boom is over. Now, keeping that thing aside, keeping the real estate aside, US needs to reindustrialize. If US needs to reindustrialize, they do not have resources in ground. But next to US is Canada where they had all the resources in ground. I believe over the next few years, Canadian equity markets, especially the resources sector, will boom big time. US companies will be allowed to come into Canada, will have massive inbound M&A in Canada. Those resources will be used for US reindustrialization. So I'm very, very bullish. I'm just looking at some signpost over here where our new Prime Minister understands this thing. He's talking about that thing. I'm still not seeing anything on the ground.
Right. And Ritesh, before we close, would appreciate your global liquidity view at this point in time.
So global liquidity at this point of time, Fed has given one more leg up. And that leg up will continue till the time one of the three things happen. One, oil prices goes out of whack. I'm talking about another $20 oil prices. It will suck away liquidity. Second thing, what will suck away liquidity? If bond yields goes out of the whack. And third thing, which can, take away the liquidity is if inflation goes out of whack. I'm pretty sure inflation and oil, you can see it in front of you. And President Trump is doing each and everything to make sure oil prices remain stable so that inflation remains stable. Whatever I can see in front of me, by Fed supporting the short end of the curve, they have made even 10 years stable for the time being. Till the time these two, three things continue to be well, your liquidity will only continue to expand. And your liquidity is expanding not from US alone. China has pumped in this year alone $1 trillion of USD, 1 trillion USD of liquidity already into the market. So forget about the US part alone. The global liquidity at this point of time is supportive of asset markets. Some will rise faster, some will rise slower. And the reason why this liquidity or why this, market will reverse or asset market will reverse is ultimately it comes down to the bond yields. Inflation will play out in bond yields. So oil prices will play out in bond yields. So keep an eye on the bond yields. Till the time they are behaved, you can continue to expand P multiples for the time being.
So one quick last question, Ritesh. So US stocks valuations hit
All time
all-time
high.
high. Yeah, so are we, I mean, fair to assume, are we in the last stage of bull market?
So in the last stages of the bull market, what happens is small cap starts outperforming the large cap. So you will see that over the possibly the last few days, small caps have now started outperforming the large caps. Basically, it's more kind of broadening out where money is moving out of mega cap tech into the other things. So with Powell also blessing this thing, you could see this market continuing to, you know, uh, continuing to not struggle, grind higher, grind higher till something breaks. When something breaks, everybody will realize at that same point of time. But otherwise, I get your point. These are the market which is at an all-time high valuation, but valuation has no meaning in today's world. If President Trump says, I want to goose the US economy, if China says, I want to goose the Chinese consumption, if Indian government comes out tomorrow and our central bank starts cutting rate by another 25-50 basis point. So at that point of time, markets can remain irrational longer than you can remain solvent.
Fair point. So Ritesh, quick view on the Indian market, and of course, we are on time.
Yeah. So either you needed fiscal policy or monetary policy. You need a support of either of them. Fiscal policy has been too tight. They are just not spending money. But with this GST thing, you think of this way that fiscal policy has become loose because you're not collecting from people, you're leaving it in the hand of people. On top of that thing, after what Jerome Powell has done yesterday, will give more confidence to our central banker to cut the rates. I believe the best is still ahead of us. Having said that thing, I do not believe our benchmarks represent changing India. If Chinese FDI is going to come into India, if Japanese FDI is going to come into India, most of the winners are just not there in the benchmark. Your benchmark is made up of services companies, not the companies which are going to get massive investment or which are required or which are aligned to the changing world. So I would say that's a stock picker market, but I'm very confident that over the next few months, if oil prices remain behaved, you will have a new leg up in Indian market. Whether it will be a new all-time high or not, I don't care, simply because I'd never look at index.
Perfect. So Ritesh, thank you so much for taking out time. It's always pleasure listening to your thoughts and really helpful in uncertain times, especially. So very